Wayne McCurrie of RMB Asset Management is with us in the studio on a day when, well, at one point in time, you just didn't know what was going to hit you next. Transhex 14%, Metarex 13%. Okay, then you get Barlow World's down 10%. These are all down, by the way.
Yeah,
Afrox 10, Nedbank nearly 9. In fact, it was over 10 at one point. Impala 8.5%, Bidvest 8%. The list goes on and on.
Yeah, Alec, look, it was everything hit the market today, but this is very typical of a fully blown bear market. Yesterday, the market looked quite good. Markets were up strongly. Nedbank was up, 7-8% on the results, whatever it was. And then today, we had the trade number, which was really bad. But I think more importantly, we had overseas news. The US GDP shrank by 6%. Now, that's an astoundingly large figure. But what to me is even worse is that this is the second time it's been released. In other words, the US always
readjusted it.
They readjusted it down. So the initial number was -3.8. This is -6. I mean, how can you make such a huge mistake? But it's destocking and exports.
And destocking is what happens in downturns. Companies just don't buy.
Yeah. In other words, even if your demand shrinks 20%, you cut your stocks and your supplier cuts the stocks, and it works its way right up the chain. That demand for a couple of months can go from 100% to zero, even if actual sales only fall 20% or 30%. It's this massive destocking.
But aren't we talking ourselves into this thing? Isn't it a self-perpetuating destructive cycle?
Now look, it happens every time, because you must remember the other way around on the upturn is people have a look on their shelves and there is no stock, and then they double order up the stock again. So you'll find during a slowdown or a recession, the first numbers are always the worst because people destock. And the same in a turnaround, the first numbers are always the best because people restock.
We thought the Rand was doing pretty well lately. Well, up until today. Took it a hammering today.
Yeah,
down
look, at
30 cents against the US.
Yeah, look, it's at 10.10 or 10.11 at the moment. Now, today it did take a hammering. But understand, looking back over a bit of time since October, November last year, this Rand has stuck at 10, 10.20, 9.80, 10.20, 9.80. The Rand's actually been very, very stable for a long time at this level, which I suppose is encouraging, but it's so hard to find anything that's encouraging.
The Rand tends to do that. It bumps around, as it did for most of last year, at 8 to the dollar,
and then
7, 8. Then a quick almost like a step change,
quick one,
up to 10. On MoneyWeb, there's a fantastic thing there called daily indicators. And if you go into daily indicators, you can click on the Rand
and get the
I'm
chart.
looking at it now. You can get a 3-year chart, a 5-year chart, and so on. But it's very, very obvious there that you do get these step changes in the Rand. Today, the Rand hanging around the 10, as you say, over 10
nothing.
Rand.
I mean, it weakened strongly today, but it didn't do. It didn't go outside of its sort of, let's call it, normal trading range.
If it had gone to 12 or something,
it didn't do that.
But why? Right, we heard the trade figures, and the trade figures were shocking
for
South Africa.
Look, don't believe 1 month's number, but that number, I mean, it was a shocker. Exports have collapsed, but we all knew this, I mean, not only have volumes collapsed, the prices have collapsed. And the fall in the oil price hasn't really helped much.
Well, we'll talk to Chris Hart about that in some detail a little bit later. The one thing that you've got to start concerning yourself about, though, is the volatility index on the JSE is going up again. That's a fear
Alec,
index.
we are within a whisker of the low we hit last year of just below 18,000. And there's every indication that the market wants to go back and test that level. These are extremely trying times. But I'll just give the listeners one thing here to chew on. You take a good, solid company, and now let's take one that we've just spoken about yesterday. Nedbank released their results. Earnings are down marginally, blah, blah, blah. You can buy Nedbank, and now this is up to date, an 8% dividend yield. Now, 8% is higher than your after-tax cash return. In other words, if you put money in the bank and you pay 40 or 39% tax, it now for the first time pays you on a yield basis to actually buy the share rather than putting your money in the bank. The yield is higher.
But that's if the dividend can be held.
But you must remember, the current share price is an evaluation of that dividend stream into perpetuity. So it might fall in year 1, it might stay constant in year 1 or year 2, but you would hope that over a 5 to 10 year period, dividends will grow at the normalized 8, 9, 10, 11%. But I've mentioned this so many times. Don't ever try and find logic in either a bear market or a bull market. They're not logical.
Well, we are going to be talking to Tom Boardman, Chief Executive of Nedbank, in just a little while, and that share price, as mentioned earlier, under pressure today, down by nearly 9%, and the financial index overall taking a hammering 2, that was 4% lower.